Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, right now, what is your market sentiment? And when I say that, I'm not talking necessarily just the stock market. I mean the currency market, the bond market, whatever the case may be. Will the market increase? Will the market decrease? Or will the market stay the same? That's a question that you need to ask yourself before getting into any trade. I don't care what it is, like I was saying earlier. We believe that every trader must make this decision before getting into a trade. Now, with that being said, a lot of times we get asked the question, well, I have this option and should I continue with it? Typically what we'll tell people is the old adage, would you get into this position today? And if you would not get into this position today, meaning if you had all your money in cash, would you consider buying this option today, even though it's that far out of the money or that far in the money, whatever has happened to the option that you're trading? And if the answer is no, I would not get into that position today, then a lot of times we tell people to consider getting out of the position. Once you figure out what your actual market sentiment is, whether you're bullish, bearish, or neutral, and once again, whether it's on the stock market, the currency market, whatever the case may be, you have to have the right position. And that's the reason why I'm putting such an emphasis on the position selection today, because this is the way that we do this in situations with our clients. Once again, not trying to get into any specifics or recommendations, but I want to emphasize the importance of risk management and setting up the right position when doing a trade. Now, are you bullish neutral? What does bullish neutral mean? Well, bullish neutral means that you believe the market, if you had to take a pick, you'd think the market's going to go up. But overall, you think it's going to stay around the same level. How about a covered call? The advantage of a covered call is that time is on your side. You can the old joke, Mick Jagger would have been a big fan of the covered call. I don't know if Mick Jagger really trades options, but maybe you could say that. I don't know. So that's one of the advantages as to what a covered call can actually do for you. Now, with the neutral sentiment, premium selling does fit the bill a lot of the times. Reason being, if the stock stays around the same level, then you have that premium that goes in your pocket. However, the saying that we have a lot of times is never fear the market, but always respect the market. Never, and I mean never, forget about the risk of owning the underlying. The disadvantage to doing a covered call is the fact that you have to take on the risk of owning the underlying stock. So, with that being said, let's say that you believe that holding the underlying is too risky for me. Well, this is where the calendar spread and the diagonal spread come into play. A lot of times, sometimes financial advisors will advise people to buy foreign bonds to get exposure to other currencies. And let's say if you don't feel comfortable doing that, another way with which you can do that with a small portion of your portfolio is with currency options. Like I said, this is where the calendar and the diagonal come into play. If you don't want to hold the entire stock or the entire foreign bond, a calendar or a diagonal spread might be a good alternative for you. You do have to pay for premium. That's a definite disadvantage whenever you're trading any option of any type, whenever you're buying an option. So with that, you need to respect the time decay risk along with the volatility risk that's actually involved in this. We typically like to use FX options for clients who need the portfolio currency hedging. With this, covered calls are typically considered an income-based trade. Now, we're not going to talk about covered calls today, but I just kind of want to use it as a segue to get into the calendar and the diagonal spread because they have a very similar concept to them. With that being said, calendar spreads and diagonal spreads are also income-based trades. Let's go ahead and start off with the long calendar spread. And what we're going to do is show you how this can be done with XYZ. That way it keeps everything simple, and you can do all of these with ISE FX options. But we want to use XYZ, and let's say that XYZ is trading at 80. XYZ is my all-time favorite stock, by the way. You can make it do whatever you want it to do. It's really a lot of fun. With that, let's say that you are bullish neutral on XYZ stock. Now, typically a calendar spreader has a neutral sentiment. It can become bullish or bearish based on where the strike prices are that you enter for the calendar spread, as well as whether it's a call or put. If you do a call calendar spread, then you are bullish neutral. If you're doing a put calendar spread, then you are bearish neutral, assuming you go right at the money, like what we're going to do in this specific example. So with that, what we're going to do first is buy the 80 call 12 months out for $5. With that, you can then sell a 2-month call against it at the same strike price for $1.75. This is not based on any real stock or anything. I just made up these numbers for purpose of education. That's what today is all about. But nonetheless, when doing that, the overall debit of the trade comes out to $5 minus $1.75. Let's look at the breakdown of this. Your maximum profit on this trade is unknown. And typically it is in an income strategy. The reason I say that it's unknown is because you don't know what volatility is going to do, you don't know what time decay is going to do, or when something is going to happen. So with that, you can say what the maximum profit would be if you held the front month option till expiration, but if you're getting in and out of this, you need to understand the fact that the maximum profit is unknown. The maximum risk is $2.25. Now we got that by subtracting $1.75 from $5. That's the difference between the call prices. The other thing, the near-term call is sold for income, while the long-term call acts as a hedge. If for some reason you were to just sell that short call option, you'd be in a naked call position. However, since you have that long-term call option, you are not in a naked position. Now, ideally, 80 80 is the
Mike,
dream price. Yes?
Mike, the risk is really 3 1/4, right?
It is. I made an addition mistake. I apologize for that. Sorry about that.
Sorry. Okay.
80 is the dream price for the underlying on expiration of the near term. Reason being, that's as high as the underlying can go without being assigned on the short call. So your near-term call option has fulfilled its obligation because it would then expire worthless, but then your long-term option would then be at its highest level that it actually could be.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.